Welcome back to International Finance. I'm Andy Kim. This is the fourth part of my week 2 lecture. Here we are going to talk about a series of financial crisis or currency crisis. First one will be Mexican peso crisis. The second one, Asian currency crisis. And the third one is Argentinian crisis. Then we'll move down to Chinese yuan issue because that is also related to the fixed exchange rate versus flexible exchange rate regime. Okay. Now, currency crisis. Three major currency crises revealed the fragility of the international monetary system. So, Mexican crisis. How did it happen? Well, here is a series of events that I understand. NAFTA agreement to establish, right? So there, newly the Mexico started to have a wide access to foreign capital flows, right? The Mexican government at that time in 1994 had expansionary policy for the upcoming election. So to make the people happy, right? Increase the employment and things like that, right? Mexican Treasury issued a short-term debt to sustain it, right? And then the short-term debt denominated in peso with a guaranteed repayment in US dollars, right? That attracted a lot of foreign investors. But then again, the presidential candidate was assassinated, and then that increased the political turmoil and the uncertainty increased. The interest rates seem to, go up with that, right? But to prevent that kind of rate increase or, capital, the risk premium, the Mexican Treasury issued US dollar denominated bond to buy pesos to sustain the peg of peso to US dollar. They wanted to keep the value of peso high, overvalued situation. The thing is, artificially increasing the value of peso, right? Or it is pegged, so it's difficult to say keep it over there or not. But it's a peg. But just to justify that one, right? But to have it, the true value of peso had to be devalued, but it's pegged over there. What's the consequence? The peso is too strong, so that import increases. Then import versus export. The deficit increases, export decreases, import increases, deficit increases. Then the overvaluation of peso becomes unsustainable, right? So how can you keep it up, right? Then the central bank bought pesos even more. How do you buy pesos? Well, spend your US dollar reserves until you deplete it. What's the consequence? Well, on December 1994, the Mexican government announced a plan to devalue the peso against the dollar by 14%. They're like going belly up, right? I cannot buy any more of peso. I'm depleted with the US dollar reserves. Then the trouble comes, the crisis, currency crisis. This decision caused pesos as well as Mexican stocks and bonds to be sold rapidly. By early January 1995, the peso had fallen against the US dollar by as much as 40%, forcing the Mexican government to float the peso eventually. Okay? Peso crisis rapidly spilled over to its neighbors, Latin American neighbors. Samba crisis happens, right? And then Asian financial markets and all around these emerging markets, they were, experiencing this fluctuation, the shock wave, right, throughout the world, because Mexico is a huge part of emerging market. Then the capital flies out of that. Well, it happens together, right? When the global funds reduce their exposure to a certain Mexican market, it reduces exposure to emerging market all around the world at the same time. So we share the same shock wave in that sense. That's what I'm saying. Now, here the chart is the US dollar versus Mexican peso exchange rate, okay? During that crisis period. Devaluation, and then eventually the floating rate or flexible FX regime started to take place. Now, the Mexican peso crisis, well, is unique in that it represents the first serious international financial crisis touched off by cross-border flight of portfolio capital. I told you, before versus after NAFTA, access to international portfolio capital, hedge funds and hot monies and all these kind of things, right? Caused this kind of crisis. And two lessons that we can learn is it's essential to have a multinational safety net in place to safeguard the world financial system from such crises. And then Mexico excessively depended on foreign portfolio capital to finance its economic development when higher priority should have been placed on saving domestically. Now, their budget situation in the government was too much lax, and then deficits, right? Always a problem anyway. And then international hot monies, and then this dependence on the international capital, right? You have to be cautious. I'm not saying that it is bad, but you have to be cautious about it, right? And then what's the consequence? There was a bailout, right, of IMF and a coordinated system, but with a lot of political turmoil in it, right? And then another lesson I may say is like the political uncertainty in that domestic, Mexican domestic politics, right? Played a lot there. So that's something, political uncertainty should be, how do you say, curbed somehow? But anyway, financial system, right? Can it be staying away from the political risk? Nah, that's a very difficult issue. Anyway, the next one is the Asian currency crisis. 1997 to 1998. That it's far more serious than the crisis of the EMS and the Mexican peso crisis in terms of the extent of the contagion and the severity of the resultant economic and social cost, right? And many firms with foreign currency bonds were forced into bankruptcy, like Daewoo Group, one of the top 3 groups in chaebols in Korea. And then it led to an unprecedentedly deep and widespread and long-lasting recessions in East Asia, a region that has enjoyed the most rapid growing economy in the world over the last few decades, right? You see the Asian currency crisis. Here's Korean won, right? You can see that it was, managed, or it was fixed currency regime before, and then we joined the OECD. With that, we had a lot of new access to international foreign capital market, right? And then eventually, with this access to foreign capital markets, Korean banks also, a lot of investment banks or merchant banks started to burgeon, and then they invested a lot into East Asia, Southeast Asian market, real estate in Thailand or whatever, Indonesia, or all different countries. The Korean banks were lax in their credit management, right? Or lax, what do you say? Not that strict, right? And then, so with a low standard of lending base, with easy money going out, and then lending money to all different places, risky places, right? They were having fun a lot of times over here, but with the crisis taking place in Thailand, right? Then the Korean banks had to suffer a lot of losses coming from this Thailand exposure, and in Southeast Asia altogether. And then there was a contagion effect naturally flowing into South Korea as well, right? Plus, I'm going to talk about this foreign currency crisis in chapter going down the road, right? Future chapters. But there was a lot of lending problems, right? The crony capitalism issues, right? Easy credit to all different kinds of companies. And then the borrowing, foreign currency borrowing was much more short-term oriented borrowing. Like you borrowed US dollars that you have to repay within 1 year. Okay? Short-term debt in foreign currency. That's very risky. Okay, we were heavily uploaded on that, so that's why the Korean the Korean companies had to suffer a lot, and then the Korean won devalued altogether with this. Let's go over here. The origins of Asian currency crisis. As capital markets were opened, large inflows of private capital resulted in a credit boom in Asian countries, easy money. Fixed or stable exchange rates also encouraged unhedged financial transactions and excessive risk-taking by both borrowers and lenders. The real exchange rate rose, which led to a slowdown in export growth, and then also Japan's long-lasting recessions and yen depreciation hurt neighboring countries. Now, the second page is like, if the Asian currencies had been allowed to depreciate in real terms, right, which was not possible due to the fixed FX rate, the sudden and catastrophic changes in exchange rate observed in 1997 might have been avoided. Okay, eventually something had to give, and it was the Thai baht. Okay, suddenly collapsing. All right, the Thai baht touched off, and then the panicky flight of capital. Again, international portfolio managers, they have to shrink down their exposure and pull out their money from these crisis countries, right? And then that happens simultaneously to all other emerging market countries, because for them it's about asset allocation between emerging market versus mature market. Okay, so spillover effect happens all across the emerging market. A lesson from Asian currency crisis: a fixed but adjustable exchange rate is problematic in the face of integrated international financial market. Okay, it invites a speculative attack at the time of financial vulnerability, and we say there's an incompatible trinity. Okay, it suggests that it is very difficult, or if not possible, to have all three conditions satisfied. Okay, you have to forego one thing at least, right, from these three. What are those three things? Well, independent monetary policy in your country, or free international capital flow, or fixed FX rate in your currency. Okay, you cannot have it all. Okay, if you want to have fixed exchange rate in your country, and if you want to have free flow of capital, then you have to forget about independency in your monetary policy. Okay, if you want to have independent monetary policy, and then if you want to have free flow of international capital back and forth, then you'll have to forget about fixed exchange rate. Conversely, if you want to insist on having fixed exchange rate and independent monetary policy in your government, then forget about having access to international capital market. That's the message here, right? Yeah, and then the way we remember, Korean people remember this East Asian financial crisis by labeling it as IMF crisis. What the heck does that IMF have to do with this crisis, so much so that we grumble with this name of it? But it's not really about the grumbling against the organization too much, but it is associated with the bailout money that we borrowed from the IMF, right? We were depleted with the US dollar reserves, right? Just like Peso crisis over there. The central, government, right? They had to, spend a lot of US dollars to protect the value of Korean wons, right? So, in the end, right, the IMF intervened and then rescued with this bailout money, okay? And the Korean people, they had to, collect a lot of gold to, repay this foreign debt. And then this is the first time that the Korean companies started to lay off people, and then the young people started to have difficulties in getting jobs for the first time. That's my generation, okay? And then at some point, people say that, you know, the IMF was enforcing too strict a rule to Korean government in their treasury, by thinking that, you know, assuming that the Korean government, you know, or Asian governments were having lax budgetary situation, just like Mexico or Latin America. I have nothing bad emotion about Latin America over here, but when you compare the budgetary conservativeness, right? Korean government or East Asian government had been much more conservative, so that they did not have to worry about the deficit situation too much compared to Latin American governments, right? But IMF was enforcing the same rule to East Asian countries, so that's why it was too harsh on East Asian economy. So the consequence was too bad, okay, too prolonged, they say, okay. So that's why, you know, we remember with some grumbling over there. The good side of it was the Korean government or the Korean people or East Asian people started to learn the international standard in a hard way to adapt to this environment, right? So that was rather a positive side of this digestion of the experience. Anyway, so the third thing is about Argentinian peso crisis. Well, what was that about? Well, it has something to do with dollarization and back and forth, right? In February 1991, the Argentine government passed a convertibility law linking the peso to the US dollar at parity, pegging, right? Dollarization. The initial economic effects were positive. Previously, they suffered a lot of currency crisis, right? But they wanted to stabilize it by pegging it to US dollar, 1991. The initial economic effects were positive. Argentina's chronic inflation, hyperinflation, right, was curtailed dramatically, and foreign investment began to pour in, leading to an economic boom. Peso appreciated against most currencies as the US dollar became increasingly stronger in the second half of the 90s, right? A strong peso hurt exports from Argentina, and I mean Argentinian beef, right? Must be, you know, very delicious. And then it caused a protracted economic downturn that led to the abandonment of peso dollar parity in January 2002. Now, getting out of this dollarization, what could be a consequence? Well, sudden devaluation, right? This change caused a severe economic and political distress in the country. It hurt, unemployment rate, right? And it rose above 20%, right? Import price increased like crazy, of course, right? Even though your exports may be advantageous, but the imports too much price increase, right? In that would not help you, right? Inflation rate reached a monthly rate of 20%, all right? So what do you see over here? This is the peso, Argentinian peso per US dollar. I said devaluation of peso, which means the dollar price skyrocketed, okay? That's what you see over here, okay? So Argentinian peso crisis, there are at least three factors that are related to the collapse of the currency board arrangements and the ensuing economic crisis. Well, you need fiscal discipline, right? Fiscal discipline. The treasury and the government has to be conservative in their budget management. And the labor market inflexibility, okay? Labor market has to be more flexible. And then the contagion from financial crisis in Brazil and Russia in that period, right? The emerging market moves together, okay? So you have to be careful about what the other countries are doing. Anyway, so that's the currency crisis issues, flexible versus fixed exchange rate regime differences, right? As you move to a flexible regime, right? The rise of Chinese renminbi is something we need to discuss. China has recently become one of the top trading powers in the world. GDP is the second only to the US. Pretty soon it's going to be number one and among individual countries, but its currency, the renminbi, has not achieved similar international prominence, right? China's currency has the potential to become a global currency, but China will need to meet a few critical conditions, which is full convertibility of its currency, open capital market with depth and liquidity, and the rule of law and protection of property rights. Otherwise, it's gonna be hard to recognize Chinese currency, renminbi, as the major currency. You think about currency war, Sung Hongbing, or all these kind of books, right? Those ambitious books about, how it's all about the, hegemony in terms of currencies. US dollar is about, major currency versus Chinese renminbi is not. But if you really want to achieve that, right, the dominance, right, as a major currency, think about all these three factors over there. Do you have this? Okay. Fixed versus flexible exchange rate regimes. Well, his argument in favor of flexible exchange rates is that it's easier it gives you easier external adjustments before giving you a total shock, right? And then national policy autonomy would be there. You remember that impossible trinity, right? As long as you want to have, right, fiscal, the monetary policy independence, right, you need some flexible exchange rates, and then by then you will be able to have the access to global capital markets together. Three things together. If you want to have fixed exchange rate and all, have the rest of the two things together, impossible. Arguments against the flexible exchange rates. Well, FX risk may hamper international trade and investment, and then the no safeguards to prevent crisis, right? So you have to be prudent if you go into the flexible FX regime, right? And then a good international monetary system should provide the following: the liquidity, and then adjustments, and then the confidence, right? Adjustments to flexible exchange rates and all these kind of things. You have to be more flexible in the market. And then fixed versus flexible exchange rate regime example. Suppose the exchange rate is $1.2 per pound today. In the next slide, we see that the demand for the pound far exceeds supply at this exchange rate. And then the United States experiences trade deficits. Under a flexible exchange rate regime, the dollar will simply depreciate to $1.4 per pound, the price at which supply equals demand, and the trade deficit disappears. So it will be like this: demand and supply. What you have on your the vertical axis is dollar per pound exchange rate, and then quantity of pound, right? The demand and supply curve will look like this. Here's the equilibrium exchange rate, right? At the beginning, you had the exchange rate of $1.2 per pound, but if you keep the dollars to pound FX as a flexible FX regime, then naturally your trade deficit, your trade deficit will result in depreciation of US dollar per pound to $1.4 per pound, like this, okay? From here to there, right? Because of the trade deficit, okay? But here's the new equilibrium price, right? Over here, quantity, right? Like this. Now, instead, suppose the exchange rate is fixed at $1.2 per pound, and thus the imbalance between supply and demand cannot be eliminated by a price change like this, right? Remember here, natural price change, right? Took care of everything. But if you enforce a fixed exchange regime, then what happens? then the government would have to shift the demand curve from D to D star. D to D star. In this example, this shift corresponds to a contractionary monetary policy and fiscal policies, which means too much reduction in government spending, which may result in huge recession. Remember, GDP should be equal to consumption plus government spending plus investment plus export minus import. G shrinks with contractionary fiscal policy. So where should we go? From this demand curve to this demand curve, D star over here. Okay, so this will be, under fixed exchange regime, instead of going here, you have to stay at $1.2 per pound. So that's why the demand curve has to shift down like drastically, which may cause a huge recession. Okay, too much reduction of your GDP. Okay, so the international monetary system went through 5 different stages of evolution. The classical gold standard determined the exchange rates by the gold content of the currencies. The gold standard still has ardent supporters. The Bretton Woods system was designed to offer a framework for stable exchange rates with pegs to the US dollar and the US dollar pegged to gold. It collapsed in 1973 or 2 due to US inflation. I'm not going to ask you the year, don't worry about it. The flexible exchange rate system has been around since 1973, and the euro has been around since 1999. And then you saw these currency crisis issues over there, flexible versus fixed exchange rate regimes. All these kind of issues we'll have to worry about as you go further down the road. Okay, so thanks for watching, and then should you have any questions, email me please, and then like and subscribe. Great. So thank you very much, and see you next week.